Okay, ladies and gentlemen, so our screencast for today is going to focus on the idea of income tax, and we're going to focus on the federal income tax. So if you look at this quote here, there are only two guarantees in life: death and taxes. Taxes have been around, since the inception of society, since the inception of civilization. But there's been all different types of taxes and ways to kind of levy income for the government from the people, as over the course of our country's history and over the course of world history as well. So federal income tax is actually a pretty relatively new concept. At this point, it's about 100 years old in the United States. And so we're used to paying taxes. And if you look at taxation as an integral part of the American story, look all the way back to the American Revolution and the reasons for why, the American revolutionaries decided to break away from the British. A lot of it is revolving around taxes, not necessarily the amount of taxation and like the financial burden of the taxes, but essentially the principle behind it and whether they have proper representation to have these taxes levied upon them. So over the course of American history, the federal government did not levy income taxes for quite some time, about 150 years. And part of that is a big legacy of the American Revolution and this fearfulness of an oppressive government that can take away part of your income through taxation. Now, of course, they had other forms of taxation like import-export tax and like tariffs, or excise taxes on famously like whiskey. But it wasn't until 1913 that they decided to create a federal income tax. And so that's what we're going to focus on today: the type of federal income tax that we have here in the United States, how it functions, how it's set up, because all of you guys have been born into a system where you're going to pay federal income tax, and you need to know how it works in order to get a grasp of like how much taxes you might end up paying. Now, like I said, this is only a part of your tax burden as an American. So keep in mind that there's New York State income tax. We live in New York City, so there's New York City income tax. There's sales tax. There's a lot of other taxes that you're also going to pay. And so this is just a part of it. Your federal income taxes are just a part of your taxes that you as an American are going to pay. So, like I said, federal income taxes were created in 1913 with the creation of the 16th Amendment to the Constitution. So they actually had to amend the Constitution in order for the federal government to be able to tax a person's income. So like I said, it's the 16th Amendment to the Constitution. The federal income tax is also known as the graduated income tax, and we're going to talk about what that means. So there's two names for this income tax that we have. It's called the graduated income tax or the progressive income tax. And the progressive income tax, that label comes from the progressive era. That's when this was created. Also, the idea that it's progressively you pay more as your income increases. So we're going to kind of break down how income taxes work in the United States and how they are set up. So it's going to be pretty straightforward, pretty simple as far as just one topic that we're going to cover, but it is a complex issue, so you want to make sure that you kind of understand it. If you have to pause the video, maybe rewatch some of the aspects of it. So what does it mean to have progressive taxation? Okay, so what that means is that as far as an income tax, so let's say, for example, you earn $100,000 and your friend earns $50,000 and somebody else earns $25,000. How, in the simplest form, progressive tax works is that the more money you make, the higher percentage of your income you pay in taxes. So that is one form of a type of federal or income tax as opposed to other types of income taxes. There are other ideas out there where, for example, everybody pays the same percentage of their income to taxes. Let's say, for example, that's known as the proportional tax. So let's say, for example, I make 100,000, same example, 100,000, my friend makes 50,000. We each pay 10% of our income to taxes. 10% of his 50,000, 10% of my 100,000. In our system, the progressive tax, I would be paying more through taxation because I earn more income. There's also a concept known as the flat tax. So the flat tax is where everybody pays the same dollar amount in their taxation. And so that doesn't really depend on your income at all. So you have different ideas. You have proportional taxes, where each person would pay the same percentage of their, each person would pay the same percentage to taxes. You have progressive, which is a system that we have and we've had since 1913, or this idea of a flat tax where everybody pays the same dollar amount. So I'm going to go through progressive taxation in some detail for you guys so that we kind of understand it, because it's a little bit more complicated than it sounds on the surface. So let's take a look at a real example of 2018, from the 2018 tax brackets that were created. So I'm not sure if you guys are aware of this, but when President Trump came into office, one of his key signature pieces of legislation that he's passed in his 3.5 years that he's been in office so far was a major tax reform. And so they changed some of the tax brackets, they changed some of the percentages that different people from different incomes paid through taxation. And so we're going to try and go through some of this stuff and talk about like what some of these things mean. So first off, what you have to understand, we're going to focus on the single side. So if you're a single filer, which means that you're filing your taxes alone. Married would be if you're married and you and your spouse file your taxes together, meaning that you add up both of your incomes and you just fill out one tax return as a married couple instead of filing singly like a single person was. So we're going to focus on this side of the tax bracket here, okay? Now, first thing you want to understand is that we have different brackets of taxation within the United States. So like 10%, 12%, 22%, 24%, all the way on up to 37%. Now, I'm going to explain to you guys how this system works, and you want to take some careful notes here. So I think a lot of Americans are under the impression, especially those that don't pay taxes yet, like a lot of you guys don't pay taxes yet. I think a lot of people are under the impression, let's say for example, let's say my income was $100,000, like the example I used from before. So under this system, most people would say, okay, well you fall into this tax bracket right here, the 24% tax bracket, and therefore they would take 24% of your income to taxation, and you would owe $24,000 to the federal government. Now, that is actually not how it works. So this is a very important thing to understand here. You have to look at it in a little bit different way. So essentially with these tax brackets, how the federal government takes your taxes, for the first $9,525 that you make, they're going to take 10% of that for taxes. So that's your first. So let's say I still made $100,000. The first $9,525 I made during that year, they're going to tax that at 10%. So they're going to take 10% away from that. From $9,526 to $38,700, they're going to take 12% of that next, that's about, give or take about like $18,000. From that, they're going to take 12% towards the federal income tax. For the next set of income, from $38,000 to $82,000, they're going to take 22% from that I've earned. So it's not, in this case, 24% total. If I made $100,000, I'd actually be paying less than 24% in my taxes, because the first $10,000 or so is about 10% tax. That next segment is 12% tax. That other bracket is 22% tax. It's only on my income above $82,501 that I would be taxed 24%. So it's really, for me, for my example, let's say $100,000, it would only really be my last $18,000 that I made would be taxed at 24%. So that's an important thing to kind of understand. So when you hear some of the presidential candidates, like for example Bernie Sanders, before he dropped out of the race, when he was saying he wants to raise the top income tax bracket, let's say to 50%. Most people say wow, you want to take 50% of my income away. That's not really what they're saying. What they're saying is they want to take 50% of the money you earn above a certain amount. So let's say it was $1 million. 50% above $1 million. Before $1 million, you're taxed at these varying different rates, as you're earning your money throughout the year. So that's kind of how a graduated income tax or progressive tax works. So So it's a little bit more complicated than it seems right on the surface, but you kind of understand, I kind of understand, and hopefully you do, why they set it up like this, because it allows you to tax different amounts of your money at different levels or different percentages. Now, the other thing that I want you guys to pay attention to that's at the bottom here, which is another important thing to understand, is something called a deduction. So what we have to figure out is, what does that mean? So this is called the standard deduction. So for a single person, it's $12,000. In the simplest term, what that means is when you file your taxes, so like tax season just kind of passed. Now they've extended it because we're dealing with an extreme situation in the coronavirus, but usually the deadline for filing your taxes is April 15th. So when you file your taxes, your federal income taxes, let's say my income was, let's make it a little bit lower. Let's say my income was $90,000. Standard deduction that the federal government's offering to you is $12,000. So meaning when I file my taxes, they're not going to tax me for $90,000 of my income. I can subtract $12,000 away from that. And so therefore, my income, according to the federal government, would only be $78,000. Now, why does the federal government do that? It kind of like lessens your tax burden. It's kind of like a way to kind of lessen somebody's tax burden. Now, I could also do what's called itemized deductions. So let's say there are certain things that I think can be written off that shouldn't be taxed, and I think it's going to come out to more than $12,000. Then I could choose to itemize my deductions. And let's say, for example, like certain things you can write off, and you'd have to look that up, or you have to have a good accountant that knows what can be written off and counted towards a deduction. But let's say I have $20,000 worth of deductions, and let's say same situation, if I make $90,000, I can deduct that down to $70,000, and I'm only going to be taxed on $70,000 worth of my income. So these are ways to kind of lessen how much taxes you're going to pay. To connect it back to our conversation before about saving for your retirement, a lot of times when you save in those special accounts like IRAs and 401ks, that deducts from your income, and so therefore that's not taxable income. So that lowers your tax bracket sometimes, or lowers the percentage you might have to pay, or lowers your income according to the federal government for the year. So that's like another important thing to grasp about this. So first thing, remember, you have different brackets of taxation, which means that on the money you earn up until that point, it's taxed at that rate. Okay. The second thing to understand is that you can reduce, according to the federal government, your overall taxable income by either taking a standard deduction, which everybody would take, or you can itemize your deductions and maybe deduct your income more than $12,000. It could be whatever it might be, $15,000, $20,000, depending on what you have that counts as a deduction. So this is kind of like basics of progressive taxation. Now, just to kind of end the screencast with, what you want to think about is, why did the American people or the American government, Congress at the time, set up their tax system to be progressive? Okay, what was the purpose behind this? So a big purpose behind this is they think it's more equitable to do it this way, because if I earn a significantly amount of money more than you, let's say I earn $250,000, if we had a proportional tax, that, let's say 15% tax that they might charge me, and somebody who's making $50,000, it's going to affect that person making $50,000 a lot more than it's going to affect me at $150,000. And so they thought this was the more equitable way to do it, was to tax different portions of your income at a different rate. Okay, guys, so we're going to wrap our discussion about progressive income tax there for now. And we will have a second lesson on progressive taxation to kind of go through and analyze, like, how does this play out? Who pays taxes? How much taxes do they pay? Do you think it's fair? Do you think it's not fair? We're really going to kind of analyze it and see what you think about it, and see if you think the progressive tax system that the government has set up and maintained over these past 100 years or so is a good system for the American people.